After a touchy second quarter, G Mining Ventures evidently worked hard to regain their low cost producer status in Q3, with the company seeing significant improvement in that metric this earnings cycle, although they have again failed to break below the $1,000 an ounce AISC mark. But while costs may be low here, G Mining seemingly doesn't want to be defined as a low cost producer story. They've also focused heavily on growth alongside steady production at a mine that has now been in operation for a year, giving us both quarter over quarter and now year over year figures to compare against. Let's dive in. G Mining in the third quarter posted top-line revenue of $162 million, as compared to $43 million in the third quarter of last year, and $130 million in the second quarter of this year. That revenue figure is off the back of gold sales of 49,000 ounces, as compared to 17,000 ounces in the year-ago period. Although, to be fair, G Mining in Q3 of 2024 had less than a single month of commercial production under their belt. Q2 comparatively saw gold sales of 40,000 ounces, meaning Q3 2025 sales were up 22.5% quarter over quarter on a per ounce basis. Average realized prices, meanwhile, improved from $23.97 an ounce in Q3 of last year to $29.92 in Q2 and $31.14 an ounce in Q3 of this year. Cost of goods sold in the third quarter, meanwhile, totaled $46 million, versus $18 million in the year-ago period and $44 million in the second quarter. All told, this led to net income growing to $124 million or 55 cents per share in Q3, a 409% improvement over the $24 million recorded a year ago, and a 155% improvement over the $49 million or 21 cents per share recorded in Q2. On an adjusted basis, net income rose to $114 million or 50 cents per share versus $17 million or 9 cents per share in Q3 of last year, and $36.5 million or 16 cents per share in Q2. EBITDA, meanwhile, grew to $123 million versus $26 million last year and $104 million last quarter, while adjusted EBITDA grew from $26 million last year and $93 million last quarter to $123 million in the current quarter. And in terms of cash flow, free cash flow moved from negative $1.5 million in the third quarter of last year and $60 million last quarter to $96 million in this most recent third quarter. The company also ended the quarter with $95 million in cash on the books, which was down from $156 million in the previous quarter. The decline was a result of a $60 million deferred payment made to Eldorado Gold in relation to the acquisition of TZ, alongside further spend at Oko West to the tune of $93 million. Moving to the operations side of things, gold production in the third quarter was up 9% over the second quarter from 43,000 ounces to 46. The year-ago period comparatively saw 23,000 ounces of production, although again, that was not a full quarter of commercial production. Total tons mined increased to 5,000 kilotons versus 4,400 kilotons last quarter and 4,700 kilotons last year, although the strip ratio declined to 1.83 versus 1.64 in Q2 and 1.55 in the third quarter last year. Grades were up year over year from 0.98 to 1.18 grams per ton gold, although they declined from 1.35 grams per ton in the last quarter. On the processing side of things, the plant averaged 12,000 tons per day of throughput, up rather significantly from 11,000 tons per day in Q2 and from 7,800 tons per day last year. Throughput is now said to be averaging 92% of capacity as compared to 86% in the second quarter. Recoveries improved to 92.3% as compared to 90.3% last quarter and 84.5% last year. As for costing, cash costs dropped from $879 an ounce last year and $763 an ounce last quarter to $721 an ounce in the most recent quarter, while all-in sustaining costs dropped from $1226 last year and $1355 last quarter to $1046 an ounce in the third quarter. In terms of guidance, G Mining has reaffirmed their 2025 guidance, which calls for the production of between 175 and 200,000 ounces. Year-to-date production sits at 125,000 ounces, putting the company on a path to hitting the lower end of guidance. On the costing side of things, cash costs were estimated to be between $620 and $685 an ounce, alongside AISC of $1025 to $1155 an ounce. Cash costs year-to-date sit at $726 an ounce, which is well above guidance, while site-level AISC sits at 1021 an ounce and overall AISC sits at 1121, both figures of which are in guidance range. Development at Oko West is also in line with budget, with the project expected to see between $200 and $240 million of spend this year, with detailed engineering and early works expected to continue into the fourth quarter. Spend at Gurupi is also expected to be in line with estimates, with a 10,000-meter drill program expected to be launched in the fourth quarter, following recent permitting there. All right, so let's wrap it up. Things are progressing well here for G Mining, who has seen production at TZ continue to expand towards nameplate capacity, while development of a second major asset is now well underway. Financing at Oko has now been secured, with construction underway, with that formal decision announced last month. Moving forward, G Mining seemingly just has to keep executing at this level to keep shareholders satisfied, with the stock up 3% on the day following the release of the results. And we suspect it will just get better from here because G Mining seems to do nothing but execute. All right, everybody, thanks for watching. If you want more earnings videos, check out our channel. Also, if there's stories you want us to cover, as always, let us know in the comment section. If you want more mining content, check out our website over at thedeepdive.ca. And if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.